So over the years, our focus has been on, in fact, financial reporting. We've focused on financial reporting over the years. Now we want to add some basic level of the financial reporting before we, journey to the advanced level. So we want to also add some financial accounting level topics. Then we can journey to the financial reporting. So the two will be coming. We'll be uploading videos or discussions on these two topics subsequently. So if you have your friend that is in the university, those that are writing professional exams at the I think the first level, that they are required to take financial accounting, and then also maybe even pre-tertiary education students that are required or that are reading financial accounting, they can benefit from this discussion. And we will also be bringing the financial reporting, the standards, and then other important topics that are examinable as well as that are needed in the corporate world. We will be doing this to concurrently. We want to expand our learning community. RONAS Academy is grateful for your persistent and consistent learning with us, and we are grateful for the feedback we've had from you, the comment, and you sharing with your friends. RONAS Academy is grateful, and we hope to continue to learn together into the future. Now, today we want to look at another important, or in fact, an important topic, both in financial reporting and financial accounting, it's in the two, and that is cash flow statement. Anytime an entity prepares its financial statement, so I'm taking it from the bottom. We'll be having discussion on all the financial statements that an entity is required to prepare, but I'm taking it from the bottom. So ideally, and in fact, a reporting entity or an entity is required to prepare its income statement, its income, and other comprehensive statements. Okay, so income and other comprehensive statements. So the income statement, other comprehensive income, or we normally also call it the profit or loss and other comprehensive income. The entity is also required to prepare statement of changes in equity. So right after the income statement, and this income statement is prepared from our trial balance. And remember that our trial balance is prepared from our ledgers. Our individual account. When we balance them up, that is what we use to prepare our trial balance. But in most instances, for external use, the first two are not important. It's the income statement of changes in equity, and then statement of financial position, and then finally the cash flow statement. So as a reporting entity that have been explained in the framework, or as an entity that qualifies to be called a reporting entity, you are required to prepare at the end of each reporting period all these statements. Now, there is a new standard that governs the preparation, that is IFRS 18, governs the preparations of the income statement. Initially, it was IAS 1, and I'll take my time to look at that later on. Now, the focus of this discussion is going to be on cash flow statement. Why cash flow statement? Why is it important? Why is it required that anytime an entity prepares its financial statement, the entity is required to add or prepare cash flow statement? Why is it important? So that's going to be our focus today. And we will also talk about the standard that provides guidelines or that gives us the necessary information or indications or guidelines when it comes to the preparation of cash flow statement. Okay, so most at times, entities, in fact, users of the financial statement or stakeholders use this statement to take decision. And if they want to take decision, they take decision based on the performance of the business, and they have to go and look for the items in the income statement. And the income statement gives us the profit for the period. Sometimes they also want to look at how well the position of the business, and they will go and look for the net asset of the business at the end of a particular period. But what is also the cash movement? What is the history of movement of cash in the business? Now, the income statement, which gives us the profit for the period, that profit determination is subject to a lot of subjectivities, or is subject to a lot of assumptions. How to determine our income statement, a lot of assumptions comes into play before we are able to determine our profit for the period. For instance, on what basis do you even determine the useful life of your asset? The provision for doubtful debt, provision for doubtful debt. On what basis are you making those provisions? Sometimes entities even make provisions for their tax. All these are liabilities or expenses that affect the profit. So sometimes the profit is manipulated, which does not reflect the true performance of the business. In one of the worldly known scandal that has to do with Parmalat. Parmalat was making a lot of profit, but its cash balance was negative. Why? Most businesses now are not concerned about the profit for the period. They are concerned about if you've made profit, can you pay? Do you have cash to pay dividends? And for us to ascertain and for us to determine this information, there is a need for us to prepare our cash flow statement to determine whether the entity, in truly the profit you said you've made, truly the entity is having enough cash balance to, effect the necessary transactions or payment the entity is required to undertake. So that is one of the importance of what cash flow statement. It helps us to also determine whether the entity is performing well or is doing well in terms of its cash balance or its cash movement over the period. And that is the focus of the cash flow statement. Also, we can use it to, take future decisions to say, because of the history of the cash flow of the business, we can say that in the next year, they are likely to make this amount of cash. In the next year, we are likely to make this amount of cash. All right. So this discussion, in fact, is going to be more or less like how to prepare the cash flow statement, both in terms of exams and in the corporate world. All right. Okay. So the cash flow statement is governed by International Accounting Standard 7. So the treatment, the preparation, and its presentation have its information outlined in the International Accounting Standard 7, which has to do with cash flow statement. According to the standard, there's a need for us to know the definition of two items. We are looking at cash, and then we want to look at what we call cash equivalent, because they will be an item or a term we will be using throughout our discussion. What is cash? Cash is cash at hand. So any money a business have in its business premises or have at the bank. Okay, in fact, have at the bank is not readily in the hand, so it will give it another name. So it's cash at hand and demand deposit. So anytime you hear of cash, in terms of this presentation, in terms of this topic, we are making reference to cash at hand, the one the business has in its premises, and the one they have in the form of demand deposit. Demand deposit in the sense that they can readily, ascertain or convert it into cash, or they can easily ascertain or obtain it. So demand deposit. Then cash equivalent is a short term. Please, this cash equivalent is very important, because when we get to the how to balance the cash flow statement, if you don't know the constituent or the component of cash equivalent, you may end up adding wrong figures or adding wrong items to different items. So what is cash equivalent is very important. So cash equivalent is a short-term, highly liquid investment. So either short-term or a highly liquid investment. In this case, we are looking at items that can readily be converted into cash. So it's a short-term, short-term, highly liquid investment that can readily be converted into what? Into a known cash. And this is subject to insignificant risk in terms of changes in what? In its value. When that happens, we say that is what? That is a cash equivalent. So it's short-term, highly liquid investment, which can be converted into a known amount of cash. And anytime we see such an instrument, for example, check is a cash equivalent. Investment that are for a short period, let's say 3 months or 90 days, or investment that are less than 365 days or 1 year, are considered as what? Cash equivalent. So if you see in question investment in 3-month government bond, that is supposed to be considered as what? As cash, not a net asset or not a current asset. Well, it's a current asset, but when it comes to the cash flow, we consider it as cash. The cash flow statement, we consider it as cash. So please be vigilant. When you see short-term investment, we are making reference to, or we see it here as what? As a cash equivalent. Now, cash flow is another term that you need to know. Cash flow is basically cash inflow, the cash that comes with the business, and cash outflow, the cash that goes out of the business. So when it comes to cash flow statement, there is not anything difficult. We just want to look at over the period or between some specific period, how much cash was generated by the company or the entity, and how much cash was disbursed in terms of payment by the company. That is cash outflow and cash inflow. And we see at the end of the day, we check to see if the balance that we have in the statement of financial position will tally with the balance that will be ascertaining in our cash flow statement. So these are the items or the terms we will be likely to meet during our presentation. Now, according to IAS 7, cash flow statement have been categorized or have been grouped under headings, and cash flow statement have been grouped under 3 main headings, and we are going to take these headings one by one. Now, before we take the headings one by one, let me present to you the questions, how cash flow statement questions will be asked or will look like. Mostly, cash flow statement questions comes in 4 different items. So assuming our focus is 2020, we are preparing our, let's make it 2023 to be more current. We are preparing the cash flow statement for 2023. The question will give you the income statement. The income statement the income statement for 2023. They also give you the statement of financial position for 2023, which is the current year. And then they also provide you with a comparative year statement of financial position. So they would provide you with a comparative. That would be the previous year, 2022 statement of financial position. Some questions will even give you statement of changes in equity. It will be added to this one. But remember, this is statement of the income statement and then other comprehensive income. It will be given to you. Then I said 4 things. So this is 1, 2, 3. Then the last one is additional information. You'll be provided with additional information. So this additional information is the one that is going to provide you with the word additional information on some of the items that have been included in the income statement, in the statement of financial position, or sometimes the statement of comprehensive income. All right. Now, when you are presented with these questions, assuming this is a full question, and you are asked to prepare your cash flow statement, the question required that you prepare the cash flow statement, giving it or grouping the items under 3 headings. And the 3 headings are operating activities, we have investing activities, and then financing activities. So we are going to go through each of them one by one, and then we also look at how we prepare the cash flow statement together. So we will go through the activities, and then we also look at how we are going to prepare our cash flow statement concurrently. So first of all, let's look at the format. So you first have to write the name of the company. So the name of the company, what statement you are preparing. You are preparing it for as at a particular period, okay? For a particular period, so we'll use the word for the year ended. It's not as at, it's for a period. So for the year ended will be the appropriate term to use. So cash flow statement for the year ended, so in this case, for the year ended 31st of December 2023. So the first, after you've given it your heading, so the heading will come. So after you've given it a heading, the next thing that will come will be your operating activities. Your operating activities. Now, under the operating activities, there are 2 methods that the entity can use to determine the cash and cash equivalent from operating activities. There are 2 methods that can be used. We have what we call the direct method, and then the indirect method. So direct method and indirect method. Direct method and then indirect method. Now, with the direct method, what is it about? IAS 7 says that the direct method is the most appropriate method that an entity is required to use when it's preparing its cash flow statement. This is where we ascertain the gross cash received by the entity. We also ascertain the gross cash payment by the entity, and we find the net of it. So, under your operating activities, I will talk about what constitutes the operating activities. In fact, let me use this opportunity to talk about operating activities. When we talk about operating activities, we are looking at the principally revenue generative activities. We are looking at the day-to-day activities of the business that brings profit, or that brings cash to the business, not profit, but cash to the business. So when we talk about operating activities, we are looking at activities that the entity engage, the ordinary course of business that the entity is able to generate an inflow or a cash from. Mostly all activities that meet the standard IFRS 15, revenue from contract with customers, we can say that they are operating activities, the ordinary course of business. So maybe your ordinary course of business is to produce marker and sell. When during the business, if you sell a vehicle, that is not revenue, it's disposal, because vehicle selling is not your ordinary course of business. So such will not fall under operating activities. It is when the transaction or the activity that the entity engage in is the ordinary course of business, is a principally revenue generative activity. There is a difference between revenue and income. There's a difference between revenue and income. Revenue has to do with the ordinary activities. The income, the entity, revenue is a type of income. Okay, revenue is a type of income. So income is broad. It takes into consideration revenue and non-revenue items. Okay, so revenue is an income from the ordinary activities of the business. That is the revenue. Okay, but with income is any form of inflow to the business. It can be ascertained from any activities of the business. So even disposal of a PPE is an income. So here our focus is on all revenue generative activities. They fall under the operating activities. Anything that you do to run a business, to make sure that the business run on the daily activities, they are all part of the operating activities. So when the entity is using the direct method, you are supposed to ascertain the gross, your total cash inflows. How much cash did you receive from January to December? How much cash payment did you make from January to December? Find the net of it in terms of operating activities. Find the net of it and then write it here. That will be cash, the net cash and cash equivalent from operating activities. But in terms of questions, in fact, in terms of exams, in terms of academic purpose, we don't use the direct method. Because if you want to use the direct method, we need to know how to prepare control account, debtors control account, and then creditors control account. And that is going to be a whole lot. So mostly questions do not demand that we use the direct method. Questions demand that we use the indirect method. And that is what we are going to present here in this discussion. With the indirect method, here we pick our income statement. Remember that this income statement is prepared with several assumptions. So not everything in the income statement is a cash. Depreciation is not a cash. Gain from disposal is not a cash. Fair value gain is not a cash item. They are not cash items. So we will pick the income statement and adjust it with the items that are not cash and items that are cash but have not been captured. You adjust that income statement or a profit or loss account, then it will now reflect cash. That is what we call the indirect method. Adjustment to the items in the income statement. In fact, we pick your profit before tax and adjust it with any item that is not cash item or any item that does not fall under the operating activities. Then at the end of the day, you are going to get the cash and cash equivalent from operating activities. So basically, that is the indirect method. So the direct method has to do with when we are using what? Gross cash inflow, cash that comes to the business, and total cash that goes out of the business. The net of it, simple. With the indirect method is the adjustment of our income statement to reflect the cash transactions of the business over the period. And we've also talked about what constitutes operating activities. All right. How do we get our cash and cash equivalent from our operating activity? Assuming we are presented with these questions, or this is our question here with in fact, like 10 additional information. How are we going to ascertain our cash and cash equivalent from our operating activities? So, like I indicated, we are using the indirect method. The indirect method. So, the first thing we bring here is our profit before tax. So we go to, where do we get that information? You go to your income statement or your profit or loss account and go then pick the profit before tax. So profit before tax, you put the value here. Now, after you pick the profit before tax, there are four basic things we are going to do. Four basic things we are going to do to get the cash and cash equivalent from operating activities, and follow judiciously. The first thing we will do is that this profit you've gone for, this profit before tax, a lot of non-cash activities went into it before it was determined. A lot of non-cash activities went into it before it was determined. Let's adjust this with any non-cash item. So that's the first thing that we do on our profit before tax. We adjust it with any non-cash item. So after you've picked your profit before tax, the first thing that comes is your adjustment. Now you ask yourself, which item has influenced or has affected this profit, but they are non-cash item. They are non-cash. The first one you can never forget is depreciation or amortization. So depreciation or amortization. So depreciation or amortization. In terms of an intangible asset, we will call it amortization. In terms of PP, we call it depreciation. Now you ask yourself, what did that figure in the income statement do to this one, or do to this one? It reduces this profit. So here we are going to add back. So here you add back the profit before tax. You add back the profit before tax. So we add back our depreciation to the profit before tax, because in the income statement it has what? It has reduced it. So we are adding back. So this is the simple thing here. Any item that is a non-cash item which has reduced the profit, we add back. Any item that has increased the profit, we less. We are adjusting it so that I can now reflect the cash the cash item. Another thing we can talk about here is impairment. Impairment is a non-cash item. So if you see impairment in the question, we are going to add back because it was less. Then we can talk about gain or loss on disposal. Gain or loss on disposal. These are non-cash item. Yeah, they are non-cash item because this one we compare our carried amount with our proceed from disposal. We can also say that gain or loss, they are investing activities. They fall under, I will talk about that. The first thing we are looking at now is items that are non-cash items. Okay, items that are non-cash items. I said four things must come into play for us to ascertain the cash and cash equivalent from the operating activities. So gain or loss from disposal. Now, if it's gain, it means that increases our profit. So we need to less. So if it's gain, you less. If it is loss, you add. You add. So we can also talk about fair value gain. Fair value gain. Now, somebody asks, what about revaluation surplus or revaluation gain? Please, revaluation gain is treated in the other comprehensive income. It doesn't affect this profit before tax. So I said we only pick items, those non-cash items that has affected or that have affected the profit before tax. So you can see that all these items here have one way or the other had an influence or had affected our profit before tax. And for that matter, we only pick those items. So revaluation surplus was treated or is always treated in the other comprehensive income. And for that matter, do not affect these profit before tax. So don't be tempted to bring your revaluation surplus over here. All right. Then, so after you've gone through your income statement, mostly this information will be ascertained in the income statement. Okay. Now let me show you how we can get our profit, our depreciation for the period or amortization for the period. There are two ways. One of them is that they will give us the figure in the additional information that depreciation for the year is this and this. Another way is that they will give us accumulated depreciation for the 2 periods. So you will have an accumulated depreciation here. Let's say here is $2,000 and here is $1,500. The difference between these two, which is the $500, will be the depreciation for the period. So there are two ways to ascertain your depreciation figure. Either you will have it in the additional information, or they will give you accumulated depreciation for the current statement of financial position and then each comparative year. You find the difference of the two, that will give you your depreciation for the current year. And that depreciation for the current year is what we are adding back here. Same thing applies to impairment. Impairment, mostly, if it's not given to you in the question, then it should be between goodwill for the current period and goodwill for the previous period. The difference is what is going to give you your impairment. Then when it comes to gain or loss on disposal, it's about you finding the difference between the carrying amount of the asset, which will be given to you mostly in the additional information. The carrying amount of the asset, the carrying amount of the asset has to do with the costs minus accumulated depreciation, the net book value of the asset. Then we compare it with our proceed, how much proceed was received from disposing of the asset. The difference of these two will either give you gain or loss. If the carried amount is greater than the proceed, then it's a loss. The vice versa is true. So if the carried amount is lesser than our proceed that we received from disposing of the asset, then that was a gain. So you will know how to treat it over here. So all this while, I've just mentioned one thing, but I said 4 things affect our operating activities. Okay, so like I said, 4 things affect our operating activities. Now let's look at the next item or the next thing that affects our operating activities. The next one is that all items that are not operating activities, but they have found their way to affect our profit, must be adjusted here. So the first one is what? Is non-cash items. The second one is what? Any item which is not an operating activity, but one way or the other has affected our profit, must be adjusted here. And one thing we can easily talk about is our investment income. So you may see this investment income in the question. And the question will be what? Will be silence on how you will not see it in additional, they will not say anything about it in the additional information. But remember that you must add it back because investment income must be treated under investing activities. So remember that investment income has increased will increase this profit, and for that matter, we are going to what? We are going to less it from here. And in fact, we are not dealing with consolidated cash flow statement. It would have been more than this, and that would be an advanced level statement, and you will probably look at it subsequently. Okay, so any item which has influence or which is having an influence on our profit before tax, but yet it's not an operating activity, must also come. And investment income is one. We can also talk about maybe dividend received. So either investment income or dividend received. Entities may invest in the shares of another company and they will receive dividends in the form of investment income. You see, so even investment income covers all those particular dividend received. Okay, so let me just ignore it. It will fall under. So anything that is not an operating activity but has influence on our profit before tax must also be captured here. Now the third thing is that we need to look at our working capital movement. So working capital movement. And here we are looking at two broad items. We are looking at our current assets and then current liabilities. So after you've adjusted your profit before tax with non-cash items and items that are not in fact operating activities, items that are not operating activities, then the next thing to do is what we are going to ascertain the movement in our working capital. And here our focus is on current assets and current liabilities. Now, even with the current assets and current liabilities, not every item is considered. Not every item is considered. So, with the current asset, what items are considered is our inventory. Our inventory. So here, our inventory is considered. Then we also want to consider prepayment, and then the third thing that we consider here is our trade receivables. Please, you will see cash or short-term investment and our current asset. They are not treated here. They have their separate activity or separate column that we treat them in the cash flow statement. They have their separate heading. So any short-term investment, any cash balance, please do not come under the working capital movement. So don't pick all current asset items and bring them here. No, it's only three: inventory, prepayment, trade receivable. And what are we looking at over here? How do we bring it here? So we will go to the statement of financial position, the current one and the comparative one. Look at the inventory figure. Let's say the inventory figure here is $2,500 and the inventory figure here is $3,100. So look at the movement between this and this. Ask yourself, has there been an increase in inventory or there is a decrease in inventory? If you compare these two very well, you can see that there's a decrease in inventory from 3,100 to 2,500. Now, this decrease simply means that there has been a cash inflow to the business. So all cash inflows must be what? Must be added, and all cash outflows must be what? Must be less. So in a fixed form, increase in current assets are less. We less them because that means there is an outflow of cash, but decrease in our current asset means what? There is an inflow of cash. So in this case, we would have added the movement here, the difference between the inventory balances, the difference between this and this, because there's a reduction in this, we would have added the 600 to our profit before tax. We would have added the 600 to our profit before tax. So this has to do with inventory. Prepayment will follow the same thing. Trade receivables will follow the same thing. So when you compare the two figures and you see, and please remember that we can ascertain this information under current assets in the statement of financial position. So if you go there, you check for the inventory figure. How much is my inventory from the comparative statement of financial position, and how much is my inventory in the current period? I compare the two. It will tell me whether there's what? Increase or there's decrease. If there is increase, it means I'm going to what? Less, because it's a cash outflow. If it's decrease, it means there is a cash inflow, and I'll add. That is with current assets. Now let's look at current liabilities. And our current liabilities, so we have a lot of items that we have: bank overdraft, we have current tax provisions, we have trade payables, we have sometimes we even have what we call accruals. Now the focus here, what we bring here is only trade payables. Trade payables and accruals. Even that there is an exception. So the only two items we bring under the current liability is our trade payables and accruals. Even the accruals, let me talk about accruals first. The accrual has an exception. We only bring the accruals here if there is an additional information attached to it. The accruals, we only bring it into the operating activities. We only find a difference and bring it here if there is what? There is an additional information. So you will see an accrual in the statement of financial position. You will see an accrual there. Let's say the figure is 100 here and 150 here. And then you go to the additional information. They've also given you accruals for the 2 periods. That is when it will come here. So you compare this, the current period to the current period, the previous period to the previous period, and see if there is any different. That is what it will come here. So if you get a question and you have accruals in only the statement of financial position, please, it is not accrual that it is for a different purpose. It's to ascertain our finance cost paid. So if there is no additional information attached, or there is no additional information giving you more information about your accruals, it simply means that the figures we have in the statement of financial position should be used to ascertain our interest paid for the period or finance cost paid for the period. So just as we did for inventory, prepayment, and trade receivable, we do the same thing for trade payables and then accruals. So we compare. But remember that whatever that we do for the assets, the opposite will hold for the trade payable. So when there's an increment in our trade payable, that means we have received more loans from our suppliers. It means there's an inflow of cash. So increase in trade payables will lead to an increase will add to our cash. And a decrease in our trade payables will simply mean that we have paid our suppliers. So that means there is an outflow of cash. And for that matter, there must be, that figure must be less. So when you are comparing, you have to check our trade payable. How much is it? So I have now talked about the third item. So 4 things affect our operating activities. 4 things must be taken into consideration when we want to determine the cash and cash equivalent from operating activities. I said the first one has to do with non-cash item. The second one has to do with items that are not operating activities but yet found themselves affecting our profit before tax. And the third item is working capital movement, and we have extensively looked at that. Now, the fourth item has to do with how to get our profit. How to get our tax paid and how to get our interest paid. Now, you know that in the income statement, there's always going to be a finance cost. Mostly there's going to be a finance cost. That figure in the income statement do not reflect your cash payment of finance cost. So please always add it back. Always add it back. So we would have added back our finance cost or interest payment. Finance cost, we would have added it back because it was less. Finance cost or interest payment was less. So it was less before we had our profit before tax. So for us to that figure there does not mean that was the actual cash payment of finance cost. The tax, this item we have here is profit before tax, so we don't touch the tax. And that tax that have been lodged in the income statement does not also reflect the true cash payment for tax. So there's a need for us to ascertain, to determine the actual tax payment and the actual finance cost payment. So these two are the 2 workings we do here. They are the 2 workings we do here. The 2 workings aside the normal ones. With the gain or loss, I remember we compare the carried amount with the proceed from the disposal. Now, how do we determine the actual tax paid, the cash tax paid for the period, and then the finance cost paid? This is how we do it. So there are 2 ways of determining it. I will use both. Then you choose the one you are familiar with or the one you are okay with. Okay, so first of all, we want to determine the tax paid for the period. The tax paid for the period. Now we will bring our balance brought down. Now this balance brought down should be the tax balance in the comparative statement of financial position. The comparative statement of financial position. The balance there under current liabilities, you will find current tax there. Under non-current liability, you'll find deferred tax there. You add the two, you pick the two. So under our balance brought down here is supposed to be the summation of deferred tax plus current tax. Deferred tax plus current tax to give us a figure over here. So please always remember that you pick the comparative period, deferred tax, current tax. And we can get this information in the comparative statement of financial position that we are comparing with the current one. So we pick the deferred tax balance there, add it to your current tax balance, add the two together. So the two together will give us a balance here. Now you go to your income statement and you ask yourself how much tax was paid there, how much tax was less from our profit before tax, how much was our tax there, bring it and add it back. So add profit or loss tax. So tax that have been treated in the income statement, add it back. You will get a value here. Now leave small space. You compare with our closing balance carried down. So how did you get the balance brought down? You picked the deferred tax in the comparative statement of financial position. So here we are going to pick the figures in the current statement of financial position. So in this case, we will pick the deferred tax in the current year plus the current tax in the current year. You will also have a figure here. Now the difference between these two figures is what's going to give us the tax we paid. The tax we paid. So let's assume this place is 2,000 and this place is 3,000. The difference between these two figures is what we call tax paid, and you will bring it here. You will not bring it here, the actual cash outflow in terms of what tax, because what was less in the income statement does not reflect or does not mean that it is what it is. It is cash. Does not mean it is cash. This is what we do to determine our actual tax paid. Pick the opening, deferred tax, and current tax, add the two together. Now, how much tax was treated in the income statement or the profit or loss? Add it, you get a figure. Compare with the closing, which will be ascertained from the current account. The current account here. Compare it with the two, and then you get what your closing balance here, and that will give us what we call the actual tax paid. Now, if you know this, what I've just done, it follows all the workings you'll be doing. Follow this format, but some individuals will want to use the T account. The T account. So you want to look at how much tax we paid. How much tax we paid. So here will be tax account. Tax account. So how much is our balance brought down? Tax is a liability, it's a provision. So the balance brought down will be a credit balance over here. Be a credit balance. Because it's a liability, any provision made which is yet to be paid in the income statement will be credited here. So the profit or loss will also be here. The amount in the profit or loss will also be here. And the balance carried down, balance CD will also be here. The difference between the two, if you sum these two, our closing balance is going to give us what we call the tax paid over here. The tax paid over here. So either you use the T account or you use the vertical format. They are all the same. They are all the same. Now let's look at the actual finance cost paid. The actual finance cost paid. The actual finance cost paid. It follows the same approach. So I'm clearing this one. It follows the same approach. All right. So with this one, we will have our tax. Our tax paid. So this is going to be our finance cost paid or our interest paid. So we bring our balance brought down. Our balance brought down over here. Our balance brought down. So where do we get this balance brought down from? Now, this is where the issue is, the accruals. So that is why I indicated earlier on that when we are looking at the working capital movement under the current liabilities, if you don't have any additional information about accruals, don't go and find the difference between these two. It is for finance cost purpose. That's why it is there. So we will pick the balance drawdown of the accruals over here. The balance drawdown of the accruals. The balance drawdown of the accrual, which is in this case, let's say 150. Okay. Then how much finance cost was treated in the profit or loss? So finance cost treated in the profit or loss, we add it to get a figure here. Then you now bring the balance carried down. The balance carried down over here. So the difference between these two will give us our interest paid. Our interest paid, or our finance cost paid. So it's going to be the difference. So the closing one will be this one. Okay. Then you pick the one in the income statement, the one that they have fleshed to get the profit before tax. We bring it here. We add it to the opening to get this one. Then the difference will give us the interest what paid. Situations where we have accruals information, additional information, accruals information in the additional information. That's additional information, accruals, in fact, information about the accruals will be used to determine the finance cost. So they would have given you the one that pertains to 2022, and they would have given the one that pertains to what 2023. So you will use that one to determine your actual finance cost paid. You don't use the one in the balance sheet. So if there's an additional information about accruals for the current year and then the previous year, we would have used that. So in addition, it will give you for 2023. So let's say the figure there is 100, is 200, and then 150. So the current year, we would have compared it with this one and this one to get our movement in accruals. We would have compared it with this one and this one to get the movement in accrual. That will come under the movement in working capital. Then when we are determining our finance cost paid for the period, we would have used the opening would have been the 150, and then the closing would have been what the $200. That is what we will use to determine what the finance cost paid. But situations where you don't have any additional information talking about accruals, then our focus is going to be on the one in the statement of financial position, and we only use it to determine the finance cost paid for the period. We only use it to here. We don't find any movement for it over here. So once you do this and you add everything here, it should give you your cash and cash equivalent from operating activities. So this is how to determine the cash and cash equivalent from operating activities. We will end our first discussion here. In our subsequent discussion, we will look at investing activities, and then we also look at financing activities, and finally we will look at how to balance the cash flow statement. Please, if you're not subscribed, subscribe, comment, share these valuable lessons with others to also benefit from. Share with your college students, those writing professional exams, so that they can also benefit and join the learning family. Still, we are comprehending the complications.